In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. Sofi has been a trending stock over the past few days and weeks, and with good reason. We're going to explore whether the stock will go higher in the days and weeks that follow, and what would be a good trading approach for the stock. Before today's video begins, if you like my content and would like to see more stock analysis videos, please like, comment, and subscribe to my channel. Sofi Technologies is a fintech company based in San Francisco. It has a mobile platform that provides a quite large suite of financial products, from credit cards, personal and business loans, refinancing, and investment services. It was created in 2011 and it went public in late 2020. So far, its peak was $25.14 on January 29th, and its bottom was $14 in August 20th. The stock has since then bottomed out at this level and recovered from there. As we speak, SoFi stock price is trading around $19.40, which represents an increase of more than 38% compared to its bottom just 2 months ago. The main catalyst in the recent month has been the obtention of a bank license that should be attributed to SoFi as a result to a merger, and it should be provided to SoFi by the end of the year. And the process should be over by the end of this year. And it would be able to provide SoFi the ability to carry more businesses and facilitate its expansions across different jurisdictions. Another catalyst is the changing tone and sentiment around the market as we speak. Jim Cramer from CNBC recently announced that now is a good time to have some exposure in new banks that are growing and that should be able to mature over time. The appeal of those new types of banks is that their infrastructure is relatively lightweight compared to the brick and mortar ones, and that they don't have to recover high amounts of fixed costs. In case of SoFi, the customer is not the client, but rather a product to fit into the mold of different services. Basically, those new banks are currently acting like the pipelines of capital. And as they mature and customers would become more comfortable at using them, they should also become the final destinations. They should also become the destinations of where money would remain. And that would give these platforms the capacity to become fully fledged financial institutions. Now, regarding the ongoing catalysts, I would also say that the fintech firms would have a very important date within the next couple of months, and that is their quarterly earnings. If the revenue growth increases and beats the market predictions, then there would be a far more sustained push upward. From a price action perspective, it seems like the stock has touched its bottom twice on August 20th and 27th, and doesn't want to test that level in the foreseeable future. On the other hand, if we look at the medium-term price action, SoFi's resistance has been around $25, and the stock would meet some choppiness when it reaches that price point. It needs to go through that zone in order to have a clear bullish trend, and I think that we will start to test it within the next few weeks. My recommendation is to keep your position if you already bought SoFi shares before, or to buy a modest position of SoFi if you don't have any outstanding position in the stock. Essentially, this position should allow you to fight off the FOMO, but not to hurt your portfolio even if it collapses. My personal standard is to allocate a percentage so that even if the stock goes down by 50%, my portfolio wouldn't feel too much pain. This means that the appropriate exposure should be limited between 3 to 5% of your portfolio. And looking at the current environment, I think that we have to be careful with buying equities in general. The market has been predicted to eventually go through a major pullback or even recession, and that its future outcome largely depends on a number of elements. First of all, after the QE years and the drastic increase in asset prices, We have to remember that the market doesn't really mirror how the economy is actually doing. Because otherwise, we would have seen a market trading a lot more sideways than upward. In fact, it's almost the opposite at times. If the economy is doing poorly, money doesn't have any other choice but to go into the stock market. And then 2020 saw another big push in asset prices, and this time, not just for the blue chips, but also the growth stocks. There are, generally speaking, two explanations. The first one is that new money is in print. The first one is that a lot of new money has been printed across the world, and because the real economy is stagnating and has been like this for years, the capital entered into the huge melting pot of globalized finance and bought up shares ever since. That was the case for more than a decade, but now that QE was touching its end in North America and slowing down in Europe, I don't think that this will be the main element that'll keep the asset prices up in the years to come. But this phenomenon has been partially compensated with the geopolitical tension across the world, and the more tensions there are, the more money tends to flow to the US and North America, because it is perceived as a safe haven for capital in different countries, especially the ones that are currently having turmoils and social unrests. One last phenomenon is the attempt of market participants to protect their capital not just by remaining cash heavy, but to concentrate their purchases in a few specific sectors so that the asset price in those sectors remain high, not only due to good fundamentals, but also because there is a very high level of demand for their equities. What all these mean for the market is that uncertainty will build up over the next month and years, and this is not necessarily a good news for stocks like Sofi, because they need a good narrative, and they also need a market that is willing to take the risk. So with all these announcements from US Fed about a recession and the buildup of economic difficulties coming from Asia, I think that we're going to see some turmoil in the month to come. But it doesn't necessarily apply to Sofi. I'm just saying, like, in general, don't put all your eggs now in one basket, because you will have opportunities to put eggs in better baskets later on, if you see what I'm saying. So my conclusion is that it's very important to keep your speculative plays at a reasonable level. A healthy portfolio normally contains most of its positions in sectors that are not only different, but that are mature, with stable and predictable cash flows, like REITs, utilities, blue chips, and preferred shares. The rest should be invested in growth stocks or to even stay cash heavy, in case there is an opportunity to scoop the bottom. In my case, my exposure in Sofi is about 0.3% of my portfolio. So overall, I think that the current environment makes me think that there will be opportunities to average down your cost basis, and this is why the initial position should be small so that we can afford the averaging down further down the road. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.